Hello, everyone, and thank you for joining our Catalyst Fund BFA webinar on proven strategies for making fintech inclusive. For the next hour or so, we'll discuss how Catalyst Fund companies are creating tangible, customer-centric value propositions for low-income consumers, all while reducing the cost of delivery. A quick FYI before we start the webinar is that we are recording this. All right, great. And I have my colleague Akansha Kasera on the line who's going to help me go through the slides. So if I'm asking someone to move the slides around, it's her. She's a digital marketing specialist on BFA's Insights and Influence team. Thanks, Akansha. Next slide, please. Great. So a little bit about myself, today's presenter. My name is Wajiha Ahmed. I am the director of BFA's Customer Insights practice. A little bit about BFA, we were founded in 2006. We're a global consulting firm specializing in using finance to create solutions for low-income people. We partner with cutting-edge organizations that touch the lives of low-income consumers, including financial institutions like banks, fintech companies, we'll talk a lot about that today, and other donors and information providers. At our firm, we're really about combining the expertise of our various practice groups. So I said that I head up the customer insights team, but we have a very strong business strategy team as well, an inclusive fintech team, a growth enabling policy and regulation team, and all of us come together to work on creating innovative solutions for this sector. So before we jump into the core meat of the webinar, we just had a quick couple of poll questions, and you can see them on the line here. And I'm just going to activate them now. So I'm launching the poll. If you could answer those two questions for us, that would be great. So the first one is just a little bit about yourself. Are you an investor? Are you an entrepreneur? Are you a technical advisor / in the financial inclusion industry? And the second is really, what do you want to get out of this webinar? Is it more about de-risking startups? Is it more about investment opportunities? Is it really the core of what makes fintech startups have a superior value proposition? Great, so people are almost done voting. There's a couple of people left, I think. Okay, great. So it looks like most people here, it's really interesting, most people are entrepreneurs. So that's great. Welcome. We're really excited to have you on the webinar. And then we have some people who are technical assistance providers / in advisory services. And it looks like most people are really keen on learning about ways that fintech startups are making finance more inclusive. Great, that's really helpful. Thank you. Stop sharing that. Okay, great. So let's jump into the heart of a little bit of background about the Catalyst Fund. So BFA, our firm, manages the Catalyst Fund, which is a global accelerator program supporting early stage fintech startups that foster innovation and financial inclusion in emerging markets. Very briefly, Catalyst Fund was started to address a common problem that we see with early stage startups. It's that really great innovative ideas in emerging markets often fail to see the light of day and never really go past the PowerPoint deck because of lack of funding. And so the Gates Foundation and JP Morgan joined forces to create this fund, the Catalyst Fund, that was really hoping to address this gap. So in 2016, the fund started deploying $2 million in grant capital and $1 million in tailored technical assistance, with the goal to reach about 20 startup enterprises around the world, across Asia, Latin America, and Africa. We just want to mention a few of the key partners that are essential to the work that we do. We work with a group of both social impact investors and commercial investors, namely Axion Venture Lab, Grey Ghost, Amidiar, Kona Capital, and 500 Startups. And they're really the ones who help select the startups for the program and provide mentorship to them. And then our firm, BFA, is the one that manages the fund and provides really hands-on tailored technical assistance to the startups. Next slide, please, Akansha. So finally, to the main protagonists, the startups themselves. Like I said, we've supported 20 fintech companies across emerging markets. We have some in Latin America, as you can see, East and South Africa. We have a couple in India and one in Sri Lanka as well. And the experiment, not to toot our own horn, but it's gone pretty well so far. Right now, we're undergoing engagements with the final cohort of 5 startups. And you can see just on the screen the diversity of business models and technologies that our companies cover, as well as some of the geographies that they cover as well. And just quickly on the next slide, there's just a little bit more detail on some of the sectors that we cover. So our companies cover everything from ad tech to insure tech to ed tech, and then even digital ID and fisheries. So it's quite a range of different tech models and different sectors. Next slide, please, Akansha. So just a little bit more about how we work so that it makes sense to you when we talk about the lessons that we're extracting. The first thing that we offer is quick and flexible grant capital. So our companies get up to $100,000 in grant capital, which is very helpful for them. But we don't stop there. We really couple that with, like I said earlier, really tailored technical assistance that's really tailored to the needs of the startups themselves. And that can be technical assistance on the UX customer insight side. Okay, great. So just a quick note that, of course, we're talking about the 20 startups in the Catalyst Fund program. There are, of course, other really great inclusive fintech startups out there that are really a driving force, that are proving to be a driving force for financial health and financial inclusion in their respective markets. We had put together this infographic of the top 100 by geography and by sector in emerging markets. We had organized it by funding. And we're really seeing a lot of parallels between what we're finding in our portfolio and what we're finding that other companies are doing in terms of how they're really pushing financial inclusion to the next level. Okay, great. So then let's get to the heart of the matter now that you have that background about Catalyst Fund and BFA and the work that we do. So at the core of it, what we've really seen is that fintech startups are building what we're calling these AAA products. So products that are more accessible for customers, that are more appropriate, and that in many cases are more affordable. And we're really seeing these companies solve for traditional barriers in these markets, like low data, lack of an ID, remoteness, and other issues as well. We have a really great infographic on the Catalyst Fund website that goes into this in a little bit more detail. Next slide, please, Akansha. And so the key question is really, how are companies doing this? How are they really building these AAA products and really doing unique and innovative things in this space? Well, after delivering this hands-on technical assistance to 20 companies, we've really observed 3 key areas where fintech startups seem to have an advantage over banks and other legacy players. And you can see them on the screen. Before I get into them, I just want to say that the reason why we think companies are able to do this is they're not necessarily complicated reasons. The first I'd say is that many of our companies and other companies outside of our portfolio that are in this space as well, they really have adopted a deep customer-centric mindset where they're constantly listening to their users, they're constantly pivoting and changing depending on what their users say they need and how their user preferences change. And that's something that we've seen across the board and that I can't emphasize enough. The other, of course, the second reason I think is that they're using tech to serve customers traditional companies have ignored, whether that's AI or ML or social media and a host of the latest tech. And so what they're really able to do is they're able to do more with fewer resources because they're leveraging the latest tech. And the third, which we really won't go into too much today, but is super fascinating, is that almost all of them are building these really critical partnerships in the ecosystem that enable them to deliver these superior value propositions. And we're really seeing that it really does take a whole ecosystem to build financial inclusion. Maybe we can have another webinar about that one day. But those are really the three sort of, I guess, enablers that are allowing this to happen. So back to the three ways that we're seeing that I'll discuss today. And the first one is this: these companies are really employing this optimal mix of tech and touch. So they're creating these new and really great interactions to both reach their customers and to keep their customers. The second is that they are creating very tangible and highly appropriate value propositions for the low-income markets that they're serving. And the third is that because they're using the latest tech, they are able to, in many cases, reduce business costs, which in some cases really translates to the end user cost as well too. But I'll talk a little bit about that later, because that's not always easy. Great. So Akansha, if you could just go to the next slide. The slide before, sorry. One more before. Okay. Great. So let's start with the first one, this optimal mix of tech plus touch. So I have two data points in there just to kind of round this discussion a little bit from with our portfolio. So in a global market where only 5% of customers are accessing insurance, Tô Garantido, which is a Brazilian startup that helps customers purchase low-cost life insurance bundles with health benefits, for Tô Garantido, 90% of policyholders are first-time insured. And then similarly for World Cover, another one of our Catalyst Fund companies, it's a crop insurance provider in Ghana that services smallholder farmers. They've enabled 95% of farmers in their coverage areas to access crop insurance. So this is pretty remarkable. I mean, what are these companies doing differently to recruit these new customers? And remember that we're talking about people here who oftentimes have never had an insurance product before or have never taken out a loan before. And of course, when you look at the details, design and affordability are important, but we really think the key differentiator here is this hybrid approach to customer acquisition that balances tech and touch. And to take a quick step back, I mean, we all know that Fintech has brought disruptive change in the past years, both in advanced markets as well as emerging markets. And its promise really lies depends on using the latest tech to reach more customers at lower costs. But the reality is that for many customers in these markets, tech alone is not enough. Many customers just aren't ready to have a fully digital experience. And so the human touch is not totally dispensable. What we've seen with our companies is that you really just can't assume that the customer will catch up. Many of them aren't digitally native, and they may never be. And that's just the reality of these markets. And so again, our companies have really adopted this mix of using both tech and human touch points to onboard customers. And what that really helps with is that it helps increase customer level of trust in services. It helps with usability issues that still exist with these types of customer segments. And it's also about giving customers a chance to ask questions or resolve issues during the crucial awareness and acquisition stage. Akansha, next slide, please. So to ground this a bit, just another couple of examples from our portfolio. Even in Latin America, where we've seen a generally more internet savvy user base, even there, it's really about creating a meaningful and effective customer journey and hitting the right mix of tech and touch. Again, it's definitely not about one or the other, but how do you have that optimal mix? And so Tô Garantido, the Brazilian startup I was mentioning before, they use a chatbot, a channel that's really popular with Brazilian consumers, to onboard clients and walk them through the purchase process. And you can see, I just took a screenshot of the beginning of the chatbot on the screen right there. But even then, some people do complete the purchasing process using the chatbot, but not everyone wants to close transactions online, and not everyone knows how. And so Go Garantido has worked out a way that certain customers can be redirected to a call center that's focused purely on these digital customers. And that's proven to be a really great strategy for them. Another example from our portfolio, one of our companies in sub-Saharan Africa. Well, one thing about Africa in particular is that a common question we hear in much of our field work is when we talk about startups in particular is people will say, okay, that's fine and great, that sounds wonderful, but where are their offices? And we hear that again and again from customers. And it's really because physical spaces are still a symbol of trust in many markets. And fintechs often don't have the brand recognition that incumbents and banks have. And so in some cases, an initial human touch point can go a long way in establishing trust. So one of our portfolio companies, a SOC, it's a collateralized mobile fintech lender in Uganda. They leverage what they've kind of called a human-enabled digitization model. And in this model, loan officers will meet new clients in person to review loan applications, and this is primarily to establish trust more than anything. Of course, subsequent loans can be processed through digital channels purely, but this first meeting is really important, and they really discovered that it was crucial for them to establish trust and to build their reputation in the marketplace. So those are just two examples on the acquisition side of how our companies are really mixing tech and touch to achieve an optimal mix. Slide, please, Akansha. Great. So, of course, this mix of tech and touch is not just about acquisition. It's also about customer retention as well. And that also often requires a very tailored approach to engaging customers. A quick example, I had mentioned World Cover earlier, the crop insurance provider in Ghana. And just ask yourself this question, right? This is a question that World Cover faced close to when they started operations. But how do you communicate clearly and consistently with a rural customer base where only 50% of your customers own phones, and then on top of that, only 20% are literate and can read SMS messages? And so this is exactly the question that World Cover faced. And you have to just think about the setting that they're in. They're in a market that depends heavily on personal relationships and trust. And they're targeting a customer base with low rates of formal education. So how did they kind of approach this? Next slide, Akansha. So in order to communicate with and retain clients, World Cover used lean research methods to identify first key customer segments. You can see them on the left. And then refine a tailored communication strategy for each of them. So for example, for illiterate users who didn't own a phone, World Cover organizes group meetings with local leaders who play important messages to the group on a speakerphone. And you can see they have a tailored way of reaching each of these three segments. And so this, they've really, I think, done a great job of using both tech and touch to ensure that that there's sufficient trust, but still benefiting from the cost advantages of tech when they can, especially for segments that have a phone and that can read SMS. Great, next slide. Thank you, Akansha. So that was just a little bit about tech and touch, and now I'll dive into the second main point that we had mentioned earlier, which is that these companies are really doing a wonderful and awesome job at creating tangible and highly appropriate value propositions. A little bit of background. I mean, we all know that in traditional financial services, people have complained about how the value proposition isn't appropriate. So there's long waiting periods, there's hidden fees, there's confusing user interfaces. And what we've seen is that inclusive fintech companies, because they have faster pilots, because they iterate constantly, in some ways they've been able to avoid some of these pitfalls and really create products that bring real value to customers. And then, like I said before, and I can't say enough, they really adopted design principles that help them get into the shoes of the user and design products that are appropriate from the very beginning. So again, they're constantly listening to users. And I'll give you an example from our insurance companies to help ground this a little bit. our insurance companies have done a wonderful job at creating tangible value propositions. So while the mainstream insurance industry is oftentimes traditionally structured, these companies have put the customers at the center of design. And what they've done is that they've tied their core insurance offering with really tangible services that people can feel and that remind people that they have insurance and that they're getting this great service. Some of these tangible services, for example, are medical visits, health services, food insurance, discount on lab services. You can read them right there for our 4 companies. And what these add-on services do is make the value proposition really tangible and real. And that's what it takes to drive this customer segment's willingness to pay for something like insurance. So that's just an example from our InsurTech portfolio. Next slide, please, Akansha. Another thing that they're doing that's really bringing their value propositions to the next level is that they're offering extreme flexibility and micro increments whenever possible. And this is really at the core of their innovative product design. And it's about allowing low-income customers to purchase smaller increments of products, or helping them do it for shorter periods of time or for lower premiums. And it's really mimicking consumer behavior in other realms as well. For example, if a low-income customer buys one piece of soap at a local Kirana shop, it's really about mimicking that behavior that already exists and buying small, affordable pieces of products. The first example, pay-as-you-go, of course, is the most obvious example of this. And I know many of you know this, but it allows customers to pay daily, weekly, or even monthly for goods and services instead of large sums up front. And Paygo Energy, it's another company in our portfolio. It's a pay-as-you-go solution for cooking gas in Kenya. They really understood that gas products were designed to be sold in bulk traditionally, and that this wasn't appropriate for low-income users because they often can't predict their income on a day-to-day basis. And so Paygo Energy developed its own smart metering technology that records gas consumption, monitors user credit, and then shuts off the valve when users run out of credit. So they've really created a value proposition that appeals to low-income customers. Another really great example we have is with Rucula, another Catalyst Fund company, and they're a digital lending startup that helps small vendors in Sri Lanka sell consumer goods on credit. I think they've reached now 30,000 clients. Rucula does not charge any late payment fees or other penalties. Instead, customers are encouraged to repay within the duration of the loan, but if they need to skip payments, the company really focuses on the longer goal of full repayment rather than adopt any harsh or coercive collection practices. And this extreme flexibility has really paid off. 95% of Rucula loans are paid off within 2 years. And so this is just another great example of how a company is accommodating deadlines as a core part of the product design and hence really offering their customers flexibility. There's a few other examples in our portfolio of this as well, which is really great. Next slide, Akansha. So now I'll just talk a little bit about the third key area that we've seen inclusive fintech companies really shine at, and that's about reducing business costs. And so inclusive fintech companies, like I had talked a little bit about earlier, they're really injecting these powerful tools into the financial services ecosystem to help reduce business costs, which can in turn translate to lower costs for the end user. I'm sure many of you are familiar with this as well, but in traditional finance, creditworthiness is based on large assets or it's calculated off of predictable income. But inclusive fintech companies are able to harness non-traditional sources of data, for example, mobile data points or social network data points, to really bring services to people that haven't had it before and do it in a cheaper way. So one of our companies is called Stockame. It's an alternative credit scoring company based in Mexico and Chile. they've opened up lending opportunities to customers that banks might have overlooked in the past. They use a proprietary algorithm to build credit scores, and they've enabled over 320,000 Chileans and Mexicans to check their credit for the first time. And they're able to do this with a very low customer acquisition cost. It's only 50 cents per customer, primarily through these algorithms and leveraging the latest tech. So we have a few examples of this as well from some of the other companies in our portfolio, especially in ShoreTech and some of our lending ones as well. Next slide, great. A quick point here as well, another way that companies have really been able to reduce costs is by leveraging the latest tech to acquire customers, so namely social media and digital advertising. So I had mentioned Destacame. We've also seen Escala do this in our portfolio. It's a higher education savings program for lower and middle income families in Colombia. It's the only savings company in our portfolio. Comunidad 41, which is a Calis Fund company in Mexico that offers financial inclusion packages for domestic workers. These companies, primarily, and most of them are in Latin America, they've really leveraged Facebook and Google advertisements as a key factor to drive down costs. I had mentioned Destacame before, which has a customer acquisition cost of 50 cents. And I have world cover there as well in Ghana, which has 25 cents. But I mean, this is interesting because we've seen this successful in some ways in Latin America, but in Sub-Saharan Africa, lowering the customer acquisition costs really does remain a formidable barrier. And finding ways to make sure that the unit economics work will be a key factor for reaching scale. One quick example of this is a company that we worked with in South Africa called MobiLife. They're an insurtech provider as well. They really tried to start off using Facebook and Google, but they quickly realized that it just wasn't working for the market that they were in. And so instead, they really did have to go back to more traditional forms of acquiring customers like radio ads, internet presence, etc. So it's not always easy to do. It can be really great on the cost side when it works, but the customer base is not always ready, and it really depends on the market that you're in. Great, next slide, Akansha. So I hope that gave you a bit of a flavor of some of the really great innovative things that our companies are doing that we're also seeing other inclusive fintech companies do as well. For us, you know, there's still some open questions, and I put a couple of them on the screen, but for us, the questions are really about, will inclusive fintech companies continue to be the owners of these enhanced value propositions? I mean, a lot of the approaches that we talked about just now are open to all providers and are really powerful agents of inclusion to learn from and cultivate. And we've seen traditional and larger actors in the ecosystem working with and learning from our companies to better understand users and create better products. And so for us, it's really this open question of whether the companies will continue to own these or whether there'll be interesting partnerships that come out of it as well. And then the second is, will these companies really be able to maintain and improve offerings as they scale? And I'd mentioned before that because fintechs are so nimble and small, they're able to constantly listen to the user, constantly pivot, constantly change. And as they scale, the question really becomes, are they still able to do this? Are they still able to be at the cutting edge of product design? And you know, our fund really works with early stage companies, but there's a lot to learn from some of the later stage companies like Tala and Branch and others as well as to how they continue to do this as they get larger and larger. And then just the last slide, which is a thank you. So thanks to everyone for listening for the past 35 minutes or so. Just to note that you can download the full brief on our, we've provided much more detail on all of this in a full brief that you can find on our website at catalyst-fund.org. And you can find many more examples from our portfolio companies on some of the main points that I brought up. And somebody just asked whether we'll share the slides. We certainly will share the slides with participants at the end. Okay, great. So I think, Akansha, now we can turn it over to questions from the audience. And if you have a question, please just write it in the chat and we'll try to answer those as they come in. Okay, so someone asked, how do startups apply to the fund? So like I mentioned before, we historically haven't had an application process. Our 5 investor partners that I had mentioned earlier, they really identify startups that they think would benefit from joining the Catalyst Fund program. So they think that, these companies are really innovative ideas. We see a lot of promise in them, but they aren't ready for those investors to invest in at that stage because of limited proof points. And so those companies will then, those investors will then nominate those companies to join the Catalyst Fund. So there isn't an application process for companies to kind of directly apply. And then somebody asked if there's a next round. Like I said, we're finishing up the last five companies in the last cohort and providing technical assistance to them. And we're working on extending the fund to the next level where we'll hopefully be accepting new applications, but that hasn't started yet. Great. Any other questions?
I have one question for you. I think I put this on chat as well. But how do you think that companies can actually find the right balance between tech and touch? Because is there like a proportion that companies should be looking at, or is there a sweet spot that they should look out for? Like, how do you find that exact balance, that how much of your operations should be tech and how many of them should be touch?
Yeah, that's a good question, Akansha. It's a complicated question. And as you've seen from some of the examples, it's highly dependent on the context that you're working in and the market that you're working in. So with the World Cover example, the crop insurance provider in Ghana, I mean, there you were really working in very rural areas with limited infrastructure compared to some, the markets where some of our other companies were working in. And there, World Cover had to really invest significant time and thought into thinking about how do we both acquire and retain customers with as low a cost as possible, using tech when we can, but of course being realistic about the ability of our customers to use digital interfaces and to interface with technology. And so there you saw that they really put a lot of effort into lean experiments, into customer segmentation, and other factors that really help them find this right balance of tech and touch. For others, I mean, if you're in markets like definitely in certain parts of Latin America, maybe in certain pockets of East Africa as well, there I think you're able to leverage tech more. And again, experiments, lean experiments, customer segmentation, these are just some of the ways that you can really think about how best to reach your customers. What I've seen personally in all the field research I've done in the past few years or so is that even in markets that we think are really advanced, like perhaps the Brazils of the world, or markets that we think where customers generally are more internet savvy, even there, what we generally find when we do field research is that you can break customers up into 3 rough buckets, and it's not always neatly broken up into 1/3, but you'll find customers that are, of course, close to being digitally native. They can do mobile money transactions on their own. They're very comfortable with WhatsApp, with using smartphones, etc. But we've always found a middle group, a second group as well, where, customers who have some exposure to tech, they're able to do some things on their own, but oftentimes they rely on agents for help, or their children for help. Oftentimes children are a really great way for people to access technology they couldn't necessarily access because their kids are actually more digitally native than they are. And so there's a second group that can do some transactions independently, but that oftentimes still need help. And then no matter where we are in emerging markets, I've always seen a third group, which is really people who don't know how to use tech. They can't even send a text message. And so we see that everywhere in all markets. And I don't think that customer segment is going to go away. And back to what I was saying earlier, we can't just expect or assume that our customers will automatically catch up and all become digitally native and use WhatsApp and smartphones. And so you always have to be aware of that 1/3 of the segment as well that is likely not going to be comfortable with tech, at least in the near future. I hope that answered your question, Akansha. I was rambling a bit. But
No, that does.
Okay, great.
We have some more questions here.
Okay, I'm trying to, so one of the questions is it possible to network and partner with startups to transfer these great solutions to another country? I think so. What I think I understand from this country is, can we sort of plant these seeds of ideas and innovation? Can we think about how they might transfer to other countries? I think we certainly can. I think if you talk about that top 100 inclusive fintech infographic, and what we've seen is that a lot of local solutions are popping up in different countries that have very similar value propositions and very similar approaches to some of these problems. I think you can certainly, there's certainly more sharing that needs to happen around solutions that are happening in one market that might be appropriate or might nudge actors or providers in another market, even if it's in a different continent. I think that there's a lot of similarities. I mean, I think one thing that really struck me, Malcolm, to your point, is that the 4 examples I gave of the insurance companies in our portfolio, I mean, they're all over the place, right? So one of them is in Ghana, one of them is in Brazil, one of them is in Mexico, one of them is in South Africa. But all 4 of them are really, their approach that they're taking is very similar in terms of how tangible and hands-on they're making insurance for low-income customers. And we're finding this in other insurtech companies as well, outside of our portfolio, companies that are early stage, but later stage as well. They're all doing this kind of independently on their own, which is really interesting. They all kind of figured it out. And so I think there can certainly be more collaboration and more sharing of these ideas, so that we can really think about what's the common thread and how can these companies learn from each other and perhaps transfer these lessons to other markets. And Malcolm, yes, I can certainly connect you with any of these companies or people if needed. So I'll send the deck around as well as my personal information, and we can go from there. And okay, you're welcome. Great, thanks. Great, that was a great question. Again, I'm just amazed at how many kind of similarities we're seeing these companies adopt, even if they're in very different markets.
I think Donald also asks a question, and he's asking, how much does demand-driven affect inclusive fintech?
Donald, can you elaborate on that a bit more? I wasn't quite sure what that meant. Demand-driven, I'm not sure. Anyways. Akansha, do you have a sense of what that might mean?
Not sure.
Okay, no worries.
Not sure.
Great. Any other questions? Great. So I think we can end there. Akansha, can you just go back to the thank you slide, because that has our website. Again, so at the bottom you can find our website. We have the Inclusive FinTech brief there. We have the infographic there that I was referring to. We have a number of blogs awesome blogs that we've written that go into detail on some of the specific technical assistance programs. And you can find a lot more there. So thank you so much for your time. We really enjoyed this conversation, and we'll be sending the slides and my contact information subsequently after this, after the webinar. Thank you so much. We really appreciate it.